Hi, my name is Paul Nichols. I'm the president of Financial Abundance, a registered investment advisor in the state of Pennsylvania. And we're coming to you as we do weekly with our virtual coaching session. Every week we take 2 or 3 minutes and just throw out a little bit of coaching. We believe that education plus understanding leads to clarity and confidence that can result in peace of mind. Unfortunately, education is not really focused on in the financial services industry. What I'd like to do today is talk a little bit about stock picking, or really the myth that stock picking works. I want to go through a few slides with you, give you some numbers and some data that you can find out, like we have as you do research and have the kind of epiphanies and aha moments that we've had when you apply an academic approach to investing. You don't have to trust on research departments and brokers that may have some insight that no one else has. Folks, the academic studies and science has been there, and in fact, it's been there for 50 years. So let's talk about stock picking. What I have here in front of me is a slide, stock selection. Stock selection is choosing any stock based on the belief that they'll do well in the future. The myth, unfortunately, is that investment advisors can consistently and predictably add value by exercising superior skill in individual stock selection. Well, what happens when we start to apply the research is that we start to see a little different story. So let's analyze this. Let's talk about survivorship bias. This comes from the Center for Research and Security Pricing with the University of Chicago. And what I'd like for you to notice here, since 1923, what's kind of interesting is there have been, well, let me back up. In 2008, there were 26,996 mutual funds open. So there were that many funds, almost 27,000 mutual funds available. By the way, that's 3 times all the stocks in the industry or in the market. It's kind of interesting. 3 times as many funds available as there are stocks available. Total mutual funds that have been started since 1923, ladies and gentlemen, is 40,175 funds. What's interesting is the total number that have been killed off is 13,179. Now, this isn't something that's talked about. So what happened? Why did they get killed off? And really, what's more alarming than why they got killed off is what happened to the return statistics for the funds that ended up in the trash heap. Well, basically what happens is they're quietly closed and merged into more successful funds. This way fund companies can post better returns by hiding this fact. So when you start to break it down, there were 200, these are 200 dead funds just recently, bottom 200 dead funds. These are the bottom 200 dead funds. What's interesting about this is you never saw this in any of the headlines, any of the mainstream media. I can't ever recall hearing of a fund being closed in the mainstream media or news. So what happens? Well, again, these statistics are just swept under the rug. In fact, when you look at the worst 200 dead mutual funds, they averaged a negative of 74, almost 75% average return. Obviously, who wants to broadcast, promote, and really talk about this type of return? No one does. No mutual fund company, that's for sure. And here's the crux of what I wanted to get to. Active management falls into the category of stock picking. And stock picking, again, it's not important what stock you own. It's not important when you buy it. What's important is how does that stock relate to all the other stocks in your portfolio, so you have a well-diversified portfolio where you own the entire marketplace. That is, if you believe the market is efficient, as do we. But what's interesting, and I don't know if this will show up on the camera, there's 2 lines here from 1973, so we're going back quite a ways, 35 years. This red kind of pinkish line up here is actually the S&P 500. So that's actually how the S&P 500 did. Compared to that, the average of mutual funds, when you look at them in that same time frame, actually did quite a bit less in return. In fact, when you invest, what did we invest here? I believe it was $100,000 invested. What you end up with is a difference of $1.5 million between just buying a simple index fund versus actively managing and trying to stock pick, market time, and track record invest. You know what? That's enough for now. This has been Paul Nichols, the Investor Coach, President of Financial Abundance. If you'd like more information about what we do, check out our website, financialabundanceinc.com. That's inc.com, financialabundanceinc.com, or call our office, 814-867-5745. In fact, we can get you a link to this entire Myths versus Truth PowerPoint. Hope this finds you well. Paul Nichols here. Have a productive day.